The way I maximize my income is by putting 10% of my money into credit spreads. I strictly only trade call and put credit spreads, especially if you trade 0.15 delta spreads. You always win. It's one of the greatest option strategies of all time, especially for scaling portfolios quickly. So check this out. Call credit spreads are amazing in market environments that are bullish but peaking. They collect massive income during these times if you pick the right strikes, like I'm going to show you. If you leave a like on this video right now and comment put credit spreads, that's going to be the next video I'm going to make. Call credit spreads are a specific type of credit spread strategy that focuses on call options. When constructing a call credit spread, you sell a call option with a lower strike price and simultaneously buy a call option with a higher strike price. The objective is to keep the price of the underlying asset below the sold call strike price at expiration, thus maximizing your profit potential. Okay, I have a lot of these positions open and I am doing really well, so I'm going to be showing you examples in this video. Before I show you an example, you need to know that this is a defined risk trade. Unlike buying naked call options, call credit spreads limit your risk. The maximum risk that you really have is the difference between the strike price minus the credit that you receive. For me, I usually like to do $500 spreads, but for some others, especially if you have a medium or a small portfolio, a $300 spread is completely okay. However, I'm going to be completely direct and honest with you. I do not like $100 or $50 spreads. In fact, they are good for really tiny portfolios, but there are costs associated with them in downsides. $500 spreads and $300 spreads are ideal. And this is the most perfect strategy for scaling a portfolio. Learning this has so many benefits, and I have a lot of these positions currently open in my portfolio. For example, I currently have an Apple call credit spread. Now, it is currently showing a $280 loss, but I have many of these positions, and over time, they have brought me in so much money. In fact, I've been able to make about 2 to 3% per week and about over 10% per month on call credit spreads, especially if you factor in the longer term picture, because yes, the market can be bullish, and this is not an ideal strategy when the market is just going straight up. I mean, if the market is just rising like crazy, then a call credit spread can get hurt. I'm being honest with you about the risks, okay? So listen up. But look, when the market is high and the RSI and the technicals, which I'm about to show you, is high, or the Bollinger Band is high, or the technical indicators that you look at are high, then call credit spreads are literally perfect. And even if the market is going sideways, a call credit spread is still a really good strategy to implement. And I'm going to show you an example on NVIDIA, because any stock that goes up a lot, a call credit spread is a fantastic time to start making money on a stock that is likely peaking or near its peak. This is a very low risk strategy if you follow the rules that I'm going to teach you. Okay, so as you can see here, I also have an Airbnb call credit spread. So let's actually open up a call credit spread so you can see the exact mechanics of how I would open this position, how I would close this position, manage this position from the very beginning to the very end to make the most amount of money. All right, so check it out. The first thing that I want to show you is going to be NVIDIA. NVIDIA is a really hot stock. It's obviously benefiting from AI. There's a lot of good news, but look at this stock's technical pattern, okay? This stock has gone right to the moon from about $146 per share, up more than double. In fact, double would have been $286, but now it's over $391. But as you can see with the Bollinger Band, it has exploded higher. I have not participated in the stock going up as much as I would have liked. However, I've been actually making really good money by doing, as the title says, call credit spreads, okay? Because when a stock looks like this, so see how this stock just had a straight momentum higher. It had little slow periods, but it just continues to go up and up. But now, as you can see on the short-term period, if I go to 3 months right now, you can see how the stock is actually stalling out. I mean, literally, it actually went up to above 400 and now is just trending sideways. And the Bollinger Band now shows 438 as the peak. And this is basically the Bollinger Band at its very best. I mean, literally, the Bollinger Band has expanded so much to account for all of the implied volatility that the current stock is showing. So now that you kind of understand that the top of the Bollinger Band is 438, and by the way, the best practice for the Bollinger Band is just to keep the very basics that Yahoo Finance is recommending. So the period is going to be 20 days, and the standard deviation is going to be 2. You can do 3 standard deviations. That's going to even widen your Bollinger Band and give you even more safety, but 2 standard deviations is already about 95% of the data that you're supposed to see. So there's only a 5% chance of something going wrong. You can't be perfect in trading. I am not perfect myself. I make mistakes all the time, but if I can win about 95% of the time, and I'm able to do that on a very consistent basis and achieve passive income, that is my goal. My goal is not to be a full-time trader. It's not to have a lot of volatility. It's to be the steadiest trader out there, making a consistent, for me, that's $2,500 per day. For you, it could be $100, $300, or $500 per day, or even more. You're able to dream as big as you want. You really need to understand that option trading is the best opportunity that I've ever seen in terms of passive income and investing. So now that I've looked at the technical analysis slightly for NVIDIA, and we now know that the stock has gone up like crazy. I mean, over this 6-month period, this stock has literally went to the moon. And yes, as you can see here, the moving average is also coming up a lot. But honestly, this stock is peaking in my opinion, because it can't just continue going to the moon. It can't become, more valuable than Apple, because it doesn't deserve to be there yet. So it only makes logical sense that this stock, yes, it can increase, but in the short term, I do not expect it to go above $438 per share. So now what I'm going to do is I'm going to open this up and take a look at the options themselves and just point out what are the best practices and then how we're going to pick a strike price. And you probably already have an idea of a good way to pick a strike price is by using technical analysis. As you can actually see here, I already had a call credit spread that is expiring pretty soon in the middle of June as I'm making this video. But this video is relevant for you to watch way into the future because this never changes. If you understand how to do call credit spreads correctly, you are going to collect consistent income and your return will far outweigh your risk. Not to mention, this is one of the best strategies for scaling your portfolio and growing it very quickly. So as you can see right here, I have a position that's expiring. I currently sold 445 and 450 call credit spread. So that's actually a little bit higher than the Bollinger Band. And as you guys can see right here, I've already made $220 for a 95% return. This is about a $5,000 cash collateral. So this percentage return right here is going to be about 5%. So I'm aiming for 5% on this position in 2 weeks, okay? 5% in 2 weeks is going to be about 10% per month, which is going to help you double your account every single year. Now, that is really important because if you can double your account in 1 year, you're basically better than Warren Buffett and the rest of the billionaires on Wall Street. So this is a very huge return. And obviously, you really need to understand risk management. Okay, let me just pause for a second because the most important thing with risk management is you have to have no more than 10% of your money in any one trade. You should have at least 10 positions in your portfolio. If you put more money than that in your portfolio, you are at a significant risk of having all of your eggs in one basket. And if one position blows up, your portfolio will suffer a lot. Me personally, I don't want my portfolio to suffer, and that's why I have at least 12 positions in my portfolio, unless there is an exception to the rule, unless I am trading SPY or QQQ, because those two ETFs have so much inside of them that they already have built-in diversification. Now, let's take a look at NVIDIA. I'm going to go to trade NVIDIA options. I already have the 445, 450 call credit spread, which has made a lot of money, but I want to open up a new position and show you how I would continue making money. And if you're watching this in the future, this is a fantastic thing to understand because you can always use my logic, copy and paste it for a future event on a stock like NVIDIA or any other stock that is looking like it's peaking or it's at the top of its Bollinger Band, or just in terms of technical analysis, a stock being expensive. And also, I didn't mention, but fundamentally, a stock can also be very expensive. And you can look at the price to earnings ratio, you can look at the price to sales ratio to get an understanding that a company is overvalued, okay? So the first thing that we want to do is we want to go to a future expiration date. For me, sometimes I go weekly, but honestly, I'm a big fan of passive income, enjoying life, and collecting a lot of income without working really hard for it. So for me, I have no problem even going 2 months out. So this option right here is 67 days out. And if I can collect a good premium and not do anything for 67 days, and my risk management is basically like, this is about 5% of my portfolio and it's not very volatile and I've collected a lot of income, that is a perfect case scenario. Learning this strategy has a lot of benefits because it's so simple, it scales, and this passive income is something that I really like over active trading. And I also want to mention that I do have a Discord community. It's the first link in the description. A lot of students of mine are full-time traders. If you're interested in making a full-time income by only working a couple hours a week, then that is a good program for you. The best thing to do is schedule a call because not everyone is a fit, and we want to make sure that we build the best custom program for you in terms of coaching with me. So before I talk about closing this position and managing it, obviously we have to open this position. So the first thing I'm going to show you is basically you start off this position by selling one call option. It's very important to sell the first call option at a proper strike price. So now what would a proper strike price be? So for me, again, I told you that the Bollinger Band is 20 and 2, and the top of the Bollinger Band is 438. So if I can do something around 438, that is going to be the sweet spot for me because I know I'm going to win this trade 95% of the time or more, okay? So what I'm going to do is, since it's 438, I'm just going to go ahead and pick something that's higher than 438. I can pick 440, and let me tell you, that would be okay, and you would probably make money. But the delta right here, I just want to point out, is 0.28. That's not really a low delta. This delta is fairly high. That means you're going to lose about 1 out of 4 trades. I don't want to lose 1 out of 4 trades, but you can already tell that this is already a very huge advantage because the Bollinger Band says this is a 95% chance of not happening, meaning that you're not going to go into the money and you're not going to have to manage this trade, close it for a loss. You're going to leave the trade alone and let it expire and collect the full income from it. Okay, so what I'm going to do instead though is I could pick 440, but I can already tell you right now, this is a beautiful trade with lots of premium, but it's slightly risky and has a good amount of volatility. So I don't want to have that type of position. I'd rather go a little bit higher to something like 450. Now you can see the delta is coming down. I can go even higher to 460. You can see now that the delta is around 0.2. So I like this because now I have about an 80% chance of winning based on delta and a 95% chance of winning based on the Bollinger Band. So for me, this is a beautiful position, okay? Taking a look at the volume. The volume is 182. The open interest is 669, which is not bad, okay? There's healthy volume. There's healthy open interest. Now, taking a look at the implied volatility, it is 42.29. For me, I like implied volatility anything above 40, okay? Now, too high, if it's like 100, that's also not a good thing because something at 100 is just way too volatile, and you probably have to kind of scratch your head and say, hey, like, is there gonna be an FDA approval? Is there like a debt ceiling, or like literally what's happening? Why is it so high, okay? There's something off about that. But between 40 and about 80, is a perfect sweet spot of high implied volatility and very good premium to be collected. So right off the bat, the bid-ask spread is not ideal, which is AKA why I also want to go a little bit later in terms of expiration. I don't want to do weekly expirations where the bid-ask is so wide because every time you trade, you are losing a little bit to a market maker, someone who's making this market and basically buying it for 745 and selling it for 815. You're going to get somewhere in between, right? You're not going to get the best price for this unless you have some advantage through software. That's just not possible, okay? Unless you work on the New York Stock Exchange and you buy a seat on the table of the New York Stock Exchange, you're not going to get these perfect prices. So that's also why I like going out a little bit further in terms of date for call credit spreads, and especially for strategies like iron condors. But look, so I'm going to go ahead and sell this 460. Now what I'm going to do, just off the bat, if I sell a 460 and I don't do anything else, this is called a naked call option. I would never ever recommend you do a naked call option because the risk is unlimited. As you can see right here, the maximum loss is unlimited. I would not recommend this. Flat out, I do this with very advanced students who have over $250,000 in their portfolio. But for most people, what you want to do is you want to now go ahead and buy another call option that is higher than the 460, okay? So we have 460. Now what we want to do is, again, go for that perfect $5 spread or $500 worth of collateral, which is a small account trade. Beautiful, right? 460. I sold. Now I can buy the 465. And what you will notice right here is that the ask price is actually 745 and this is 745. And that's the negative thing with options sometimes is you really have to look out for liquidity, okay? So the liquidity here is not ideal. And again, talking about the difference in the bid-ask spread, it is not good because the difference is about 65 cents. So the difference here is 65 cents. And here it was also about 65 cents or, even more than that. So that's an issue because, there is a price to that. However, you will notice that the maximum profit is still 68. So the market isn't dumb. They're not going to give you zero for this trade. You're still getting paid a decent amount. You're making $68 and you're risking about $432, which is roughly a 1/7 return or about 14% in 2 months. So 14% in 2 months is about 7% in 1 month. So a 7% return is going to scale your portfolio very quickly, but there's a few more things that you really have to understand to making this position work, like managing the risk around it and then actually managing to close it for a profit, okay? So here's the thing, when you actually go ahead and click continue and place this trade, you will notice that the bid is 0 and the ask is 135. But that's okay because you can still get the middle point, which is about $68. Now, once you open up this trade, the money enters your account immediately. So with this $68, you can go do some grocery shopping, pay your electric bill, or just continue to scale your portfolio with this new premium. Okay, it enters your account immediately. Now, what you will have to do though is you have a position that is open in your portfolio that's going to show you a negative $68 balance. So that's why your balance doesn't change, but your cash will change as soon as you open this position. But the only thing that you really have to do is just kind of monitor this position. And what I mean by monitor is go live life, don't really look at it, but just keep an eye out once in a while to make sure that it is not going into the money. And the good news is that the strike price that I picked is 460 and currently Nvidia is at 391. So there's a very low chance that this stock is going to go from 391 to 460 in a snap of a few fingers, right? So what you can do is you can basically ignore this position, continue to make passive income, and only look at it maybe like once a week would be my suggestion. So if it actually goes into the money or near the money, you can start thinking about rolling this higher. Now, I'm not a huge fan of rolling spreads higher because there's also fees involved. And just in terms of management, I like to keep my management as low as possible. So the highest statistical return that I've learned after working at Goldman Sachs and talking to many mentors, including having a mentor on Wall Street, having a mentor that worked at Wharton, the Wharton School of University of Pennsylvania. They've all told me that basically less management is more ideal. So what I would like to do with this position is I'd like to hold it up until August 18th, unless it goes into the money. So if it goes to like 462.5, like it's in between my two strike prices, then it's really important to kind of ask yourself, do you think the stock is going to come back down based on technical analysis and fundamental analysis? If you think it's going to come back down, then it's okay to hold. But if the stock is clearly showing a very strong momentum, which I would really doubt with this type of position right here, this position is going to work out. In my opinion, I would totally feel comfortable to open up like $50,000 without a problem. But if it does go into the money, then what I'm going to do is I may close this trade out, just call it a loss, call it quits, and just keep moving on in life. Or if I feel like this stock could potentially be peaking and in the next future period of 1 month to 2 months that it won't go any higher or won't go too much higher, then you can also close out this position and then open up a very similar position, basically rolling this position higher. So you can roll it higher from like 460 and 465 to something like 490, 495. You may not get enough premium to compensate you for the loss, but you will still collect more income and reduce your current loss on the position. Now, again, I don't really expect to have loss on this position, and if it happens, so be it. I have losses every, 1 out of 20 trades. That's just part of being a professional trader. And not even a professional trader, just a retail investor. We're all gonna have losses. Where people make the biggest mistake is position sizing. So people literally don't understand position sizing. They fall in love with the position, they get super emotional about it, and then they end up opening like 25, 30. Gosh, some people open up half their portfolio in one single spread, which I think is absolutely insane. You do not want to open up too much of your money in any one position. Now, if you have 20 different spreads, and by the way, you also have to have put credit spread, so don't forget to comment put credit spread in the comments if you want me to make that video. You have to have both. You can't just have only call credit spreads, because if the market is very bullish, then you are going to end up losing money. And we don't ever know where we truly are in the market. Nobody can truly predict the market. That's just never going to happen. So that's why you need to have call credit spreads and put credit spreads in your portfolio. But one of the most important skills that you have to have is rolling. And I just made a rolling video that you have to check out right here.